So it's a big issue. And when I hear people promoting things like we don't have to worry about spending, we should just spend, I don't find that history supports that, and I don't find that the laws of economic nature support that either. So what does it take to get people to focus on it? It may take some pain. And in the U.S., we can go a long time. We're the currency that the rest of the world wants to trade in. We have a strong economy. And so I don't know the answer to how far can you go with your debt to GDP before markets think you've gotten out of your skis, but you should care about that.
Speaking of debt, you mentioned one of the words that you have is corporate debt.
Yes.
And it's come up lots of times, and especially in the private equity markets. Some of these fan banks, whatever you want to call them, it's not traditional lending. So how do you monitor that? How do you kind of bake that into the whole situation? Because when we're talking about debt, so that's where the public.
So one of the things the Federal Reserve has done since the financial crisis is to issue something called a financial stability report. And I think the last one came out this summer. And it's a way to tell the public, here are the kinds of things we're watching. Here's where we see vulnerabilities in the economy. And they kind of color code them. It's like green if it seems okay, and yellow if it's caution, and orange and red if it's on fire. So you look across all the things that are vulnerabilities, and corporate debt is one, historically high. Corporate earnings are coming down. And so it raises a question about, okay, what does that mean for the economy? And the answer is, just like I said earlier, trying to size what the risk is, when it will happen, how big its impact is almost impossible to know. So then you say, well, what would we do if something happened? So one of the things you do is to say, are our institutions that are most critical during a downturn able to function? And I'll just give you an example, the banking system. The banking system is critical in a downturn to know they have capacity to manage any losses they take and lend. And a lot of people take comfort from the fact that the largest banks that were bailed out in 2008 and 2009 have more capital today than they did back then. I don't take much comfort from that. Because having something compared to nothing doesn't tell me if it's enough. And so, knowing that the 5 largest banks, any one of them stumbles, it hits our economy hard, is why I've advocated for, if you're going to see these risks, you have to do something to assure the public it'll be okay if something happens. And my solution to that is to have higher levels of capital. Not more regulation. I think we over-regulate most anything we can get our hands on. So, but it doesn't mean we shouldn't think about, if we can weather a storm, we want to know we put in place those kinds of protections. So the corporate bond market is one we watch carefully. We're seeing more risk-taking. This is the other thing that happens when you lower rates. You incent people to take on more risk. That's just the name of the game. If you're a pension fund, you've got to meet your pension obligation some way. And if you can't do it with safe assets, you will go out and find yield, which usually means taking on more risk. I may have told this group this before, but back in 2013, I may have disagreed on a policy decision or two there too, but I heard from a retired gentleman in Blue Springs, Missouri. And in 2013, he was 88 years old. And he called me and he said, "Thank you for advocating for higher interest rates, because people like me are being punished. I'm a saver. I've saved all my life." And he was afraid he was going to outlive his savings with those zero interest rates. Earlier this year, he called, and so now how old is he? Now he's 94. He said, "I wish you'd quit. I wish you'd quit dissenting about low rates." I said, "Wait a minute. Aren't you the guy that was cheering me on saying higher interest rates?" And he said, "Oh yeah, that was then. Here's what's happened now. I cashed in every one of my CDs and I put it in the stock market. Because every time you lower rates, I see the stock market take off. So, you judge how you weigh the benefits of lower rates and risk-taking to them. I hear his voice in my ear every time I go to a meeting. Yes, please.
Off the wall question, but I'm sorry, go ahead.
That's all right. Here, and then I'll get you.
What do you see as the worst-case scenario for the economy, and what is the probability that we may see negative interest rates here in the States as compared to what we see in Europe and Japan?
So worst-case scenarios are hard to play out because they will either be way worse than I would try to imagine, and there's, what we do, though, and I do this with my staff, is think about, we try to set what we call a modal outlook, which is what is it we expect as a baseline outlook. But we're very clear about here's what has to happen to make that come true in our world of thinking about the future. And so we will think about alternative scenarios. What if the trade situation is not resolved in a positive way? What if it turns out that there is a shock to the economy? And again, one thing we know is the economy is not likely to grow indefinitely. We have not overcome cycles from wherever they come. So let's say manufacturing doesn't get better, the rest of the world doesn't grow as much, and we find ourselves in recession. So that is part of the policy planning process to look out across there. The thing I think the Federal Reserve is taking very seriously is the fact that we are at such low interest rates. And it's true globally, but certainly here, which is what happens if we're hit with a shock. What tools do we have to respond to that? And so you've seen this year the Federal Reserve engaged in a very systematic process. They branded it Fed Listens. Jay Powell was here a few weeks ago to host one of those sessions where we brought in the community and business leaders to say, how do you think about interest rate policy and what the Fed says? Do you understand what we say when we communicate? It didn't hurt our feelings because we kind of figured out a lot of people don't understand. But you raised the question about negative interest rates. So we have seen today some $15 to $17 trillion of debt at negative interest rates. So countries like Japan, Europe, Switzerland has gone this route to say, if zero wasn't enough, what can we do? So basically, when you move to negative interest rates, you tell your banks, good luck, because now, not only do you not have a margin, you must charge your customers to keep their money with you. Or your customer will take their money and put it under your mattress or whatever alternatives they look at. My own observation, so I've been watching this closely, I don't see that it's getting their economies to grow, to address the issue. So when the FOMC has talked about what kinds of things we would do, you will hear policymakers very publicly say, we see these other countries doing it. First of all, we don't have to think about that now here, but we also want to be very careful. So you will see the Fed talking more about, would we do more QE? In other words, would we go out in the market and buy more assets for our balance sheet? That's likely because we've done that before. The other thing is how we would talk to the markets and the public about, here's what you could expect from us. So we're not going to raise rates until, you could say, until employment gets here, until inflation gets here. So that's also considered a kind of tool that a central bank could use. So not a fan of negative interest rates because I just have not seen that they've had the traction that I think these central banks were trying to get. And we should, that's why we need to worry today about it, so that when we get to that next shock, we have an idea of how we'll respond. Yes?
I've heard you speak like 3 times now, and always been impressed by how you can take a complicated topic
And dumb it
and
down.
simplify it down to people like me. So honestly, I'm curious, your speaking ability, your eloquent, articulate, or sincere. Is that something that you identified early on, or did you learn trial by fire as you progressed in your career?
Of course I did. I haven't had formal training. Let me tell you where I got my first and really best lessons for that. So in 1982, I went to work for the Kansas City Fed as a bank examiner. And if you were around during that period, it was a bit of a banking crisis in our region. It was both real estate, ag, energy, all tanking at the same time, when we had hundreds of bank failures. And I'll tell you where I made my worst mess-ups was sitting across the desk from the CEO of a bank who had been maybe the fourth generation, who'd been in that chair 30 years, and telling him what was wrong with his bank and what we were going to do about it. And I got my head handed to me several times on two fronts. One is, you know, when you're young, you're pretty positive about what you think you know. So I pretty quickly learned what I didn't know. And the second thing is, I learned if you can't explain it to the banker, and the banker can't explain to you what's going on, then you don't understand what's going on. And so we live today, so I learned that's really where I got my growing pains around speaking. Standing up in front of a group talking about monetary policy, a whole different thing. I got a staff of folks that help me get my story straight, the facts straight, so I get a lot of help with that. But the truth is, one of the best compliments I ever got after a speech was someone coming up to me and saying, "You really know how to dumb it down." And at first I thought, uh-oh, they think I'm an idiot. But maybe I am. But it was a high compliment in this sense. If the central bank cannot explain to the people who are most affected by its decisions what it's doing and why it's doing it, then we fail, I think, at the end of the day. Because John mentioned the first central bank of the United States, the second one, they didn't last very long. Not because they didn't know what they were doing, it's because they did not capture the trust of the American public. In fact, because they were concentrated and were making these decisions, people so distrusted them that they wouldn't support renewing their charters. And so the idea that we created the third version of a central bank in this country took a cue from something that is so important, I think, to this day to the American public, and that is we don't trust concentrated power. And we want to be able to see that an institution that affects us is going to be able to explain to us what it's doing and how it's doing it. So thank you for your comments, but it is every day, all of us at the Kansas City Fed, and I think my colleagues around the country, want to earn that in their regions to say, we listen and we respond based on that. Thank you. All right. Yes, then I'll give you.
In 1979, I moved here and bought a new car dealership. And shortly after that, floor plan went to 21%. And I'm just curious, that was so, I mean, it put so many people out of business, including me.
Yeah.
Will that ever happen again?
Well, I'll never say never. But one of the things we've observed, the actions that the central bank took, and I give Paul Volcker a lot of credit during that time, that was very painful. Paul Volcker understood that double-digit rates of inflation in our economy was eroding the purchasing power of the dollar, would affect standards of living over a period of time. And he took actions that were very painful in the near term, but we now today see that inflation around the world, because other central banks began to follow this idea of don't let inflation get out of hand. Keep it low and stable, which of course is our mandate from Congress. Keep that low and stable. So central banks, like the Fed, have said 2% inflation can be tolerated, but you don't want it to get too low because then you worry people won't think there's any pricing power. You certainly don't want it to get high. Under what conditions could we see inflation rise? we were worried a little bit watching some of the tariffs. Would those be inflationary? And I think for a period of time, you may have seen it in steel and some other things, but in a broad-based way, it's hard to imagine, again, this is a function of our global economy, that you will see those kinds of inflation pressures, at least over the near term. But conditions can change, and we know they can change quickly. The question about our federal debt is something I watch, just to see if that begins to lose confidence in markets and other things, you could also see a big pressure around inflation.
Could you address the effect of the tariffs on the farm markets for Kansas especially?
So in our region, if you go back to 2013, I have a little farm up in northwest Missouri. Those were golden years. Commodity prices were high, land values were high, and then all at once, commodity prices weren't high. And so we've had about 5 years where farm incomes have dropped dramatically. And on top of that, then, the tariffs came in on soybeans in particular. There were some other angles that affected farmers. But it has put additional pressure on the farm sector. So I characterize our farm sector in our region as under stress right now. And those who are most stressed are those that carry debt in their operations. They may have extended during good times to buy equipment and other things. So I suspect the thing that has been propping up a lot of those farmers has been the fact that their land values have generally held up. They've been able to go into their banker and say, we renegotiate, extend the time, you've got low interest rates that give them some breathing room. But that won't last indefinitely. And we're already beginning to see bankruptcies in the farm sector begin to tick up. Not anywhere like we saw in the 80s by any means, but I think you are going to see, unless something changes, pressure on the farm sector, and that will either force consolidations. Again, you will see some go out of business. So it's a tough time in our farming communities as we look around, because remember, in those communities where farming is still dominant, the whole town, the whole community relies on that. So we watch that carefully. Yes, please.
It's always struck me as maybe one of the best kept secrets about the Federal Reserve is the amount of work you all do, both in programs and in research around low-income communities and people in poverty. I guess, can you talk a little bit broadly about what you see as the Federal Reserve's role in equitable economic empowerment for communities with high levels of poverty?
Yeah. We talk about the Fed broadly as having obviously a very visible role as setting interest rate policy. We are a bank supervisor. We run a number of the payment systems in this country, including providing financial services to banks. But we have always believed as a regional institution, one of our obligations is to understand economic development, what the barriers are, and what the opportunities are. And so while we can't write checks to people and we can't target a low interest rate to this group versus that, one of the things we can do is to convene. And that's often how we use our facility down in the Crown Center area in Kansas City, is to bring resources together so that community people that need funding and those that have funding to give can be brought together. We also do research to understand what is the underlying issue that helps poverty, advances poverty, issues around, you hear a lot about minimum wage, low-income people. We think by bringing that research forward, it can help others who do have those responsibilities to help solve for those issues. And at the end of the day, we know that for this economy continue to grow, you are going to have prosperity and opportunity. It doesn't mean everyone will be wealthy. It doesn't mean that you can reallocate wealth, but you can give people a path. They need to understand what education means to them today. They need to understand what kinds of skills businesses are demanding. So one of the things we see in the labor market, I just told you how tight the labor market was. It is really disheartening to see how many men in their prime working ages are not participating in this labor market. And there are lots of reasons why. Some are drug related, some are because they don't have the skills, they've given up on finding a path into the workforce. Those are the kind of issues that we can contribute to the discussion about in our role. All right. Melissa's going to give me the book. Thank you very much. It's been wonderful to be here.
Obviously, everyone was very attentive listening to you, and I do appreciate the dumbing down because economy and all that was never my strength in school. So, thank you. And also, I was going to let you guys know is you're going to see some changes on your drive through Fairfax to work. We came up with a design for monument entrance signage in Fairfax. We don't have anything that says you're in Fairfax. We're almost 100 years old, so I think it's time. We have a revenue source to pay for that now. So the signage, the design concepts are on the website. Now we have, the city has put out an RFP for design build part. So we're moving along, and the B25 is part of incorporated into the design. And hopefully, I'm optimistic that by spring or summer, it'll be out. Do you think that's reasonable, John Tinser? I'm pushing for it. Plus, we have you probably met some of the Rosies that are real Rosie the Riveters that are in their 90s, and they've come to the festival. And they're like, Melissa, you got to get this sooner than later. So hopefully you'll see that in the spring or summer. With that, we're going to do some door prize drawings and wrap things up. Who wants to come draw? John, Dickie. Does everybody have their cards in? We have a lot of prizes here. Anyone? Okay. And John, you want to pick what we draw first? Okay, JB's going to help. What are we going to go for first? A gosh? Full set? You said full set? Drill? Of course, drill. I don't know what's this weekend. All right. Wayne Schmidt, Innovative Facilities. All right. Next we're going to do, this little one. We just got one of those for some tailgating last weekend. Very neat.
The weather is perfect for a picnic right now, so.
Give me a draw. Okay. Let's see. Bank it. Sandra. What is that? Levi. I'm like, I don't know why I was starting with that. It looks like we got a cheap hat and jacket. We had a lot of people checking that out.
All right.
Okay, you're going to reach into that.